The poor man's covered call option strategy was the topic of a recent live monthly Zoom call for our community over at stockmarketoptionstrading.net. And we're going to get into all the details in this video. To learn more about our free monthly Zoom sessions, head over to the website and check the events section. And if you're looking to grow your trading account and generate income trading options, consider subscribing to this channel and liking this video to let YouTube know that you're a trader and you want to see more videos like this. Now let's get into the strategy.
And really what the poor man's covered call, it's a long diagonal debit spread. And it's used to replicate a covered call position. And the strategy gets its name really because it costs less to get into the trade and there's reduced risk. And it's a bullish strategy. So you definitely don't want to be putting this strategy if you don't have a bullish thesis on the underlying stock or even the market in general. And sometimes I don't really like the term poor man's covered call because one, it's really not a totally inexpensive trade to put on. And two, I think a better name is kind of a leveraged covered call. So, but it's quicker than saying diagonal debit spread or diagonal calendar, that kind of thing. But so that's what it is. We're actually trying to replicate a covered call without buying the stock. So the basics, again, we're trying to replicate a covered call instead of doing a covered call. So we start with buying a long expiry call. And that's going to be our substitute for buying shares of stock. So, and I've read a lot of stuff on different strategies on how you might want to select this call. And a lot of people kind of comes down to you either want to go deep in the money or you want to be highly leveraged. So somewhere between a 30 and an 80 delta is what you want to be using for your long call. And the trade provides leverage because it costs a lot. And I'll show you in just a minute how much less it costs. So then once you've bought your long call or your stock substitute, then you actually sell calls against that until you either hit your profit target or run out of time. And again, it's a bullish strategy. And the short calls, what they really do is they will reduce the basis in your trade. So whatever you paid for the stock, every time you write a call against it, you're reducing the basis in that long call. And these are usually longer term trades. You're going to be in this trade somewhere from a few weeks to several months. So it's not one of those trades that if you said, oh, I think it's going to go up in a week and I want to get out, it's probably not the best strategy for that. But if you think over time it's going to go up, this is a great strategy. And it's almost like not a boring strategy, but it's just one you just have to keep kind of selling the calls and monitoring your cost. And then, so the trade setup. The first thing you want to be looking at is, what stock or ETF do you want to trade? And personally, I've kind of evolved that I only sell ETFs on this strategy. An individual stock, you got to deal with earnings at least every 3 months. So I used to do stocks right after earnings and sell the poor man's covered call, but I'd rather just have more time. So even if you do it a day after earnings, you're limited to 90 days. You've got to theoretically be out of the trade before another earnings event. So in terms of selecting the long call, what I do, I'm looking out between 60 days, and that's a really short period, up to 180 days. So I try to get in that 120 to 150 range in terms of buying that call. And then you want to decide, what delta strike do you want to buy? And one of the things that I always do, I'll look for a certain delta range, but then I'm looking to see, what's a strike that's in that range that makes sense. Like, for example, if I might be choosing, between, I look for a even number like a 100 or a 105 or an 85. You want a big number. You don't really want like a 87.5 call or something like, or a 92 call. You want to try to call, select something that's, has enough open interest. And what you'll see is a lot of times there's a lot of option strikes, but a lot of them don't have a lot of open interest. And yes, someone had asked, will we be sharing the PowerPoint? Yes, I'll definitely be sharing the PowerPoint with everybody. So we're going to go out. I generally start at about 120 to 150 days. And then I look for what strikes have the most, have the most open interest, and then I focus on that. And now your lower delta strikes, they cost the least and they provide the most leverage. And then your higher delta strike, they cost more, they have less leverage, but it's going to move a lot closer to how the stock moves. I know last month, Eric, you did a presentation on delta, and a stock is a 100 delta. So if you go in and you buy the 80 delta, it's going to function pretty much exactly like the stock, but it's going to cost you more money. If you want to do a 30 delta, it's going to act a lot less. It's going to move a lot less than the stock price, but you have a lot more leverage. So it's really just a personal preference there. I try to look at about the 40 to 50 delta personally. That's where I find you get the most. It kind of, the price is good, and the returns are good. So any questions about that so far? Okay. So here's just a quick example of the delta. So I went in today to get as current as I could, and I looked at XLE. So this is, you hear a lot of people saying that energy is kind of an in favor sector. That was at least until today. And so the ETF, XLE ETF, was trading for about $53.46 a share. So if we bought 100 shares of this to sell covered calls, it would cost us $5,300. And that would tie up our money. However, if we went out to September of this year, which is really only 4 months away, we could sell the 30 delta, which was a 60 call, and that would cost us $1.60. And a 46 delta was the 55 call. That would cost $3.20, $320. Or you could go in and be, as close to kind of the stock and buy the 80 delta, and it would cost you $950 per contract. So really, even the 80 delta is 1/5 the cost of buying 100 shares. And the buying power reduction here, I went back and I sold a call against it, the same call, and I'll show you in a minute. But you can see that the buying power reduction based on this is really not a ton of difference. The 30 delta was actually lower than the 80 delta for some reason. I've always found that kind of to be the lower the delta, the higher the buying power reduction. So as you're putting these trades on, you want to look at your broker to see how much money they're holding aside to put this trade on, because it'll vary a little bit. And but you can see here, just the close to the 45 delta really only cost you $320 to trade covered calls against the XLE. So that's why a lot of people like the strategy. And so when you get up to the SPY, it takes a lot more, costs more to get that. But there's a lot of really good ETFs that you can trade the poor man on and make a great return. Any questions about choosing the delta? Anybody do the this strategy and use a particular delta?
I mean, I'm more personally interested in the theta.
Okay.
I want my long option to have really low theta relative to my short option.
Okay, so, okay.
Hey, Brian, can you go back to that? And I just want to make sure I understand the relationship when you buy the Delta 30 call, for example,
Mm-hmm.
For $1.60.
Right.
Why is the buying power reduction $13.50?
And I kind of had that question too. It's the way the broker, or at least Tastyworks, calculates what is the max loss that could happen if you sold a call against it and it blew through that call number. So
that, I'm sorry, that buying power is
this buying power based on selling a call against it.
Okay, that's inclusive of the okay, just
yeah. I kind of skipped that. I just wanted to include like what both pieces were.
Right. Interesting. Okay.
Yeah, and a question that come in on how far out do I sell the calls? I'm generally selling them about try to sell them weekly. So if I put a call on to, if I bought the long call today, I'd probably be selling next Friday's expiration. But that could be, that's kind of just my style of trading. You could sell monthlies against it if you wanted to, things like that. Okay. And okay, so selling the short call. I recommend selling the weekly calls against your long call because you're able really to generate a lot of income and really reduce that your basis in the stock. I actually had a gold trade, GLD, where I sold enough calls where I had totally eliminated my basis in the long call, which with about 3 months to go. So that was, almost like a risk-free trade. So you can do that if you sell a lot of calls against it. And going back to what strike you sell, you want to make sure that you're selecting that shorts call based on some plan. So you could either use a delta, say I'm going to sell between the 10 and the 20 delta every week. I want it to be above the resistance level and beyond the expected move of the stock. So you can kind of set it up that way. When I first started, I just sold the 10 delta, and I always felt like most of the time it didn't even come close. So, but I'll look at that. I'll choose the delta. I look at the resistance level and the expected move of the stock. So you're selling these, and again, you can sell weeklies, you can sell them every 2 weeks, or whatever you feel comfortable with. And then you got to make sure when you're monitoring this is that you want to make sure that the stock or the ETF stays below that short strike, because unlike a covered call, you're not going to get assigned 100. They're not going to take away your shares of that, because all you have is basically two separate trades. You have a long call and you're selling a short call. So you want to make sure that you're like, oh, they'll just take away my long call. No, they'll just assign you the shares. So you want to make sure that you really don't sell a strike that's too close, and then you have to roll it. So And then a lot of times what I'll find is I'll sell the call, and maybe I'll get, $45 for that call. And by Wednesday or Thursday, it's worth $2. So that's when I would take it and roll it out to the next week. I don't generally let them expire, because by the time at the end of the week, there's almost no value by the end, with like 2 or 3 days left in the week. And when the short call does get challenged, and it'll get challenged, that you want to keep rolling that out and up and taking additional credit. So that's how I do the strategy. Any questions?
Brian, what if you can't roll for a credit?
If you can't roll for a credit, that generally means that your long call is pretty profitable. So at that point, I look to close the trade. Because remember, if you're buying that long call and the stock price moves up to your short strike, say it was a 10 delta, then you've had a pretty nice, movement on the stock. So you're making, if you chose a 40 delta, for example, and the stock moved, 10 points, the price of your long call will have gone up about $4.
Right.
So,
And then you look to stay out of that ticker, which you feel has gone too high, too fast, and look for something much lower.
Yeah, what I generally do is if I look at, the IWM, the SPY, the Qs, if I see one of them drop like 2% in a day or in a couple days, and I think that it's just basically a market shift kind of thing, that's when I would put the trade on. So I'm usually looking for some kind of a pullback. This is probably your ultimate buy the dip strategy.
Ryan, do you find that the bid-ask spread is high on some of those long calls?
Yeah, I mean, that's one problem, is that you do have a wider bid-ask spread. So, especially I think if you go further, like down to the 30 delta or something like that. So you want to look for the strikes that have the most open interest and the shortest and the smallest bid-ask spread. But yeah, you'll see that sometimes, and sometimes that's the reason. Like sometimes you'll see people that talk about the strategy. They say you should go out 365 days, and you'll see that is even a bigger problem, with a big bid-ask spread. But you can find ETFs, index ETFs, or sector ETFs that don't have a super wide bid-ask spread.
Hey, Brian, does is there any kind of relationship between the delta of the long call versus the short call? Because I'm just thinking, I've always kind of leaned toward, I haven't really done this that much, but I've always just kind of been taught or read about buying like an in the money call and selling out of the money calls. But if you're buying a delta, let's say 50 call, and selling a delta 20,
right?
But then at some point, let's say the stock starts to move lower, can you sell the call, but that's actually below does it have any relationship with the strike you're in versus?
No, I think the only relationship is that the broker may take more money and set it aside on the trade. But I've traded it both ways. So at the exact same strike, lower strikes, it doesn't matter. Because really it's two different kinds of trades.
It's two trades, but it's basically your long call's hedging your short.
Yeah,
okay, so you could buy a delta 30 call and sell something below it.
You could.
Shorter duration.
Yep. And as a matter of fact, I think when Art did a presentation sometime last year, he recommended selling the lower, like a 30 delta. So So I've kind of found that probably that 40 to 50 delta is kind of my sweet spot.
That you buy?
That I buy, right.
And then you sell something like a 10 or
10,
20.
15, maybe. Yeah.
Right. Okay. Thanks.
Because I think where I've run into trouble is if I got aggressive and I sold a 20 delta and the stock blows past that number, then you're adjusting the trade and you might have to get out early. So I would prefer to, sell that 10 delta, collect it a few times, reduce the basis down. Then you're in a position, where you can sell it for a nice profit.
Right.
And I know I'm running a little bit over, so I'll hurry up. The managing the trade, I generally try to exit for about 50 to 75% profit on these trades. So just as a quick example, if you paid $10 for your long call, so you've paid $1,000 and you've collected $4 in credit, $400. Now your basis in the stock is $6. So if you're able to sell that long call for $10, then you're making, a $400 profit against a reduced basis. So you're making like a 66% return. So they do generate a lot of, a great return, especially I think if you can buy them on a dip and then you could ride them back up to the previous level.
Can I ask a question about that?
Sure.
Why wouldn't you consider the credit taken in as return and keep your original cost basis the same? So say you paid $10, it's still $10, but now you have $400 of profit plus.
Yeah, and you can do it that way. It is $400 of profit, but when to me, it's harder to track your results. If every week you're collecting, 50 cents, $50, and then over an 8-week period, now you've collected $400. How do you kind of combine, kind of show what your actual return on that entire trade was? So it's the same $400. So you could do it that way. There's no right or wrong answer. I just like to track how much credit I took in and what did the entire trade make? Okay.
And I just ask because the percentages are different. If you do 1,400 over 1,000 versus, some 400 over 600, I think.
Okay.
So you got 40% versus 66%. The 66% sounds a lot better, but I used to count it against, especially if you sell enough to get close to zero, like you said on the GLD trade,
right?
Then your ROI is astronomical.
Yeah, and I to tell you the truth, I never even thought about doing it that way. So it's just the way I kind of learned it and kind of followed it that way. But there's nothing wrong with doing it the other way.
Okay. Thanks.
I just think it would be a lot harder to track it. Sorry, someone was going in.
Yeah, Brian, have you played with, because this is something I've done before, but they call it juicing the income by selling an additional call credit spread on top of the short call. So it's effectively like a ratio spread that's on top of the long call.
I've heard of that and I've seen it. I personally haven't done that, but I mean, it's you definitely could do that.
Yeah, because your credit could be increased, like in your example of $4, that could be $6. Usually it's something, maybe like a 50% increase in income.
So you're selling a call spread on top of that.
Yeah. At the same delta.
Same delta. Yeah. I mean, I think that's a great idea.
The risk is if the stock soars, you're not going to capitalize on the stock movement.
Then you're gonna have because it's technically more of that's a bearish trade. So right. You could get in trouble. But if you're picking, something like a 10 delta, it might work.
I mean, it's the same trade though, right? You're buying a call and selling a call. So
right.
That's why I was asking about like if you're buying a call and then selling one lower.
Yeah, but it's a different time frame. Different expiration.
Okay, that's right. It's a different time frame.
Yeah, but gotcha. The idea of selling another call spread on top of that definitely would juice your returns. And like someone else mentioned, if it blows through there, then you got a problem because that's technically a bearish trade.
Yeah, it doesn't really work that way. You still actually gain more from the long call because if it blows through, you lose on the call credit spread, but
Right.
many weeks of the extra income
Yeah.
usually outweighs it.
Yeah, I like the idea. I'm going to have to think about that. That's good.
Yeah, Tasty Works calls it juiced income. I think it's their term for it.
Okay, that's interesting.
To get
Thanks
that
for-
in the risk
Or
profile.
juicy calls. Juicy calls.
Juicy call. Okay. Oh, thanks for sharing that. And then, when to enter the trade. So I generally wait for some kind of a pullback. If there's, it's the index, XLV, XLE, or the SPY, if there's a pullback of, 2%, and I think it's just a temporary thing, that's to me is the perfect time to enter this trade. Some people wait for, a second test of the lows. It hits a low, it moves up, they wait for it to come back. That's when they want to enter it. Or the other thing is if, you see a particular sector that has now become kind of in favor, and you think, over the next 3 to 6 months, this ETF could really kind of, appreciate in value. This is a good way to kind of take advantage of that on a leveraged basis. And then I've done this before, but with mixed results on stocks. Say you have a really good stock, and particularly if it has good earnings and it still pulls back, that's when I might try to do it on an individual name stock. But like I said, I've had mixed results on that. So I personally just stick to ETFs. And takeaways, again, it's an excellent bullish strategy. It's a leveraged trade, so you have a lot less capital requirements. There's multiple variations like we've heard today. I've learned about juicing the credit, which I love. You can do it I recommend trading it more on ETFs. You don't have to worry about earnings events and things like that. So you just tend to, hold them a little bit longer if you need to. And it's important to kind of track the credits as profit as you do them, or reduce the basis and calculate the entire trade, which is pretty much the same, just a different way of doing it. And again, these trades can take, you can be out of this trade in a few weeks, or it could take a few months. So, but it's probably not one that you're going to enter on Monday and be out on Friday. So just wanted you be aware that it's not a short-term trade. And let's see what else. Okay, after the buying on the dip makes, I think, improves your chances of profitability. So anyway, and now I have any other questions that I didn't answer for you guys? You had a lot of great questions.
Brian, so we talked about the wheel and poor man covered call. I thought of, is there an interesting way we can actually merge the two, where I love the poor man covered call, but I don't like to get in until there's a dip, and selling puts is a great way for myself to, to discipline myself.
Right.
So how can we sell puts, and then when we get in, we actually do the poor man covered call, like sort of merging the two?
Yeah, I mean, I think that's a great idea or a thought, but I think when you sell the wheel, you're selling puts, and what the result is, you're going to get the shares of stock versus the poor man, where you're actually saying, I'm basically doing a substitute of buying the shares. So
does it make sense to unload the shares and then buy the call instead, or that's just actually just generating a loss because you're selling the shares lower than when you're assigned?
Yeah, what you could do is, if you were doing the wheel strategy, say you were, pick an ETF, say you're doing it on IWM, and it reaches, your short put level. What you could also, and you took the shares, you could at the same time buy, create a poor man's covered call.
Yeah,
because you got your, that's your dip basically. And that's how I would see how you could kind of build that out.
Yeah.
Interesting though.
Okay.
Any other questions? You guys have been great. I always love it when people ask good questions because I don't have to just stare at my screen.
Just one comment on that concept of the juice trade.
Mhm.
If you were really bullish on the stock, why would you sell a call spread as opposed to a put spread?
I guess it's probably just a matter of how bullish you are. I mean, if you're bullish on the stock but you're selling a 10 delta, your probability of getting up to that 10 delta is pretty small. And again, I don't trade that, but I think it's an interesting idea.
Thank you very much.
Sure. And then some people asked about our Facebook group page. I have a Facebook page that's called the Conservative Covered Calls Facebook group. And I post trades in there. I do the wheel strategy. I do a trade where we capture dividends. Maybe we could talk about that sometime. And I do some in the money covered calls. But you're welcome to join the Conservative Covered Calls Facebook group page. And I also have started putting some of my trades in Eric's group. And I just got to be a little bit more diligent to put them in there, you know, your Mighty Networks trading group. So, but if you do have any other questions, you know, don't hesitate to shoot me an email, and I'll get the PowerPoint slides up. And as soon as we get the recording kind of done, I'll get that out so we can you can see it again, or if you missed it. So I'm going to stop the recording.